Welcome back. Let's get into that market picture now. And we start off in the Far East. Asian stocks advancing on Tuesday, and that's particularly on optimism over that US-China trade talk and provisional deals to avoid a Washington shutdown. Now, while the weak yen did boost exporters as well. Now, initial trade talks are underway in Beijing, which are aimed at averting punitive tariffs, which could slow the global economy. Top-level negotiators are set to arrive in the Chinese capital for meetings on Thursday and Friday. That's ahead of that March the 1st deadline day. It was all green across the board in the Far East as Tokyo's Nikkei took up 2.6% of gains to close out at 20,864 points. The Hang Seng was lifted 0.1% to 28,171. Shanghai Composite gaining 0.7%, ending the day's trading at 2,671 points. Let's head on over to the United States now, where Wall Street seesawed on Monday, rarely straying far from opening levels as investors eyed ongoing US-China trade talks and the potential for congressional gridlock and a diminished 2019 earnings outlook. Now, with both Beijing and Washington expressing optimism about the trade negotiations between the world's two largest economies, fourth quarter earnings growth is now estimated at 16.5%, up from 15.8% at the beginning of the year. The Dow Jones Industrial losing 0.2%, 25,053 points. S&P 500 also edging up 2,709, while the Nasdaq Composite was also up 0.1%, 7,307 points. It seems a sense of positivity has come through the market picture, even on the local front. More than 1% of gains thus far is how the market is currently sitting. So a lot of that has trickled through to the rest of the world, but a lot of the factors remain the exact same ones we've had for the last couple of weeks. That is the US shutdown, the US-China trade talks, and of course Brexit. How far do we get and how close do we get to those deadline days as March comes closer, of course? Let's check in on those numbers and we'll have a chat just about how things are going in just a bit. A slight strengthening of that South African currency there at around 13.74 against the US dollar. We've obviously seen it a whole lot better. But having taken on that 13.80 mantle not so long ago, things have progressively gotten a little bit better. And that's despite the situation in Eskom. So let's chat about that and a whole lot of other economic and financial issues now. Devin Shute from the Robert Group joining us. Devin, thank you so much for the time. But haven't seen you this year, so Happy New Year.
Thank you very much.
A progressive year to you, we hope. So the market today, more positive and perhaps a little more beneficial coming through with things, China coming back online fully today as well. Sense of positivity perhaps for the remainder of the week. Sustainability of this, you think?
Look, I think the local story, we maybe got a takeover from the positive Asian session, but I think this weak rand, which came in with the shock of load shedding yesterday, has helped to prop up a lot of the dual listed stocks. I think globally the big picture, as you rightly explained, was very much about this China trade war and the kind of Valentine's date that the two superpowers have on Thursday. The market's pricing in clarity and some sort of resolution. We're going to have to see it, otherwise things are going to get a bit messy. Yeah,
I mean, that US-China trade talk has been continuing for the longest time. The US dollar was strengthening, and a lot of that, some people were attesting to that trade talk. Did that necessarily mean that the US was out in front in that deal?
Look, it's impossible to say what's happening behind those closed doors. I think that they have the ability to negotiate harder than China. I think they're in a stronger negotiating position as such. I think that the dollar will benefit from the outcome, whatever it may be. But yeah, I think we've got quite a potentially uncertain time ahead if things don't go as planned.
Well, I do want to start off by welcoming our four viewers as well there from the State Capture Inquiry. We're just taking a look at how the markets have fared thus far as well today. Up 1% thus far for the JSE, still below 54,000 points. A lot of positivity coming through from the industrial counters and the gold shares.
Yes.
Speaking of gold shares, Harmony coming out with a set of earnings. Their profit, however, not looking too good. Headline earnings per share going down 94%. The PGM's doing well, but gold not so much.
Yeah, look, there's quite a few accounting reasons for that. So operationally, it was actually a good set of numbers. They doubled their operational free cash flow. Revenues were up significantly. And what had happened is they'd brought new silver and uranium mines on stream, some of those in places like Papua New Guinea.
Yeah.
And so as a result, they're writing through amortization and depreciation, which affected the profit. But it's looking like a healthier and healthier group. And I think not a bad set of numbers.
A lot of them are becoming leaner though, aren't they? I mean, the leaner businesses seem to be now streamlined, a whole lot more effective and efficient. Does this bode well for the industry as a whole? Or is it really just about survival for the entity itself?
Look, I would argue both. I think lean and meaner cost cutting is always good. I think what you're also seeing is a diversification away from reliance purely on gold, into these other base metals and precious metals. Sibanye-Stillwater did particularly well in doing that, and I think you're seeing it from the other players too.
Yeah. Well, here's the big one. You must have driven up from Durban and thought to yourself, okay, yes, fine, I have a whole lot of meetings, but you come up to a whole lot of this load shedding now.
Yeah.
Stage 3 today,
The situation at Eskom, whether it be the debt, whether it be the restructuring, whether it be leadership, all of it is just in complete shambles at present, even though we're looking for ways to fix it. It doesn't seem like we've gotten that turnaround strategy in place.
It doesn't feel like it. It feels like it's really crisis management mode, and I think it really is that bad. You know, I'm seeing Eskom as the single biggest risk to the fiscus, and it's not going away. When your revenue or your profit can't even cover the interest on your debt, you've got massive problems. So Moody's came out and said that this much vaunted unbundling into the 3 separate groups is ratings neutral, so they don't believe it's going to have a big effect unless we get the transparency and the efficiencies coming through. I don't see how they're going to get away without a government bailout, so not just an increase in the guarantee, but actually ponying up probably 15 to 20 billion rand just in the short term to keep the lights on. It's dire. The only positive I can draw from it is that in moments of crisis, you know, we're really forced to look at ways through it and, you know, look for more innovative solutions, but they're not forthcoming yet.
And a lot of answers are going to then be pointed at Tito Mboweni, and he needs to deliver some sort of sentiment around how they're going to restructure that debt, or how they're even going to help fund it. I mean, you don't just split something up like that without giving it further investment, right? So should the expectation be that they'll get further funding or some sort of bailout?
Yeah, I think they have to. I think they don't have a choice. I think what you're probably going to see is generation, which is really where Madupi and Kusile would sit and where the problems are at the moment. I think you're going to see a lot of the debt being earmarked there, almost ring-fenced, you know, kind of like have a good Eskom, bad Eskom, like they would do with the banks. I think you're then going to see the other two parts potentially be able to raise their own capital in a different way. So unfortunately, you know, government really fighting with hands tied behind their back, and it's a long fix. There's no short-term solutions.
How do we get rid of the unemployment number now? 27.1%, 27.5%. It doesn't make a difference, really, does it?
No, it doesn't. And I mean, unfortunately, I think this, you know, marginal reduction was really just due to seasonal effects in the fourth quarter of last year. You've got people coming into hospitality and that type of thing. That should reverse this quarter, unfortunately. But as you say, the structural impediment to getting our people working is chronic. And I mean, if you take Eskom out the picture for a minute, I think it's the single biggest blight on the economy that we all need to be involved in solving.
Biggest fear for you this year?
Look, my biggest fear is that things with US interest rates don't go well, that they continue to raise faster than the market's expecting.
That would hurt.
That would hurt a lot. That would draw liquidity out of the system, and that would really create some really uncomfortable market conditions. I think it's unlikely, but it can happen faster than we somewhat predict, so I'm watching that closely.
All right. Devin, appreciate your time this afternoon. Devin Shute there from the Robert Group giving us just an update on that market picture and perhaps some of his fears as we head into the remainder of 2019. A lot, of course, still expected. As we said, that unemployment number coming out at 27.1% as well from Stats SA. So do we manage to take down that plight and perhaps decrease it a whole lot more? We'll unpack that a whole lot more right after the short break as well. Do stay tuned to On Point. From me, that's where the buck stops.